Hello, good afternoon or good evening. My name is Will Upshaw. I'm with American Financial Network. Thank you for checking out the virtual home buying seminar. One of the things that I want to make sure I touch bases with you here is give you some information about myself, about what I am, what I do, as well as about the home buying process so you can have a better understanding of what to come. Some of the key things I want to go over with you really quickly here is this is my name there, loan originator. My NMLS number is 826975, and that's one of the things that I'm let you know that I am located or have a license in four states: Michigan, Colorado, Florida, as well as Georgia. Here's my contact information here. That's my direct line, my cell, so you can text with that number as well. Also, leave a voicemail message. The number is 231-253-9586. Also, here is my email address. It's first name, last name at afncorp.com. And my branch is located here in Maryland. Now, I'm actually located in Michigan, but the branch that I operate out of is located there in Maryland. Some brief information about myself. I stated that I'm a loan originator, my license. One personal things about myself is I've been married for 23 years. I have four children, four kids, and two of them are adult kids. Now, even though they're adult kids, they still come back and forth to mom and dad for assistance and help, and I'm glad I'm able to help them do those things there. Um, Another thing is I served 16 years in the United States Air Force. Um, Also, I have over 13 years of experience in real estate as a realtor as well as a loan originator. So, letting you know, the person that you speaking with you today have well over a decade of experience. So, that's some information that's crucial to provide you the most current information, but also that have a history uh, in this business there for you. Okay. One of the things here, you've seen this meme going around a little bit, but this one is designated here that some people are paying more in rent than you would in a mortgage. So just keep that in mind. So before we continue on there, I just want to have you watch this quick video here and tell me what you think.
This spring, your house became a school, an office, a gym. You went to the movies in your living room, attended church in your backyard, video toasted your friends and coworkers during online happy hours, dance parties, and book clubs that turned into wine tastings. 2020 brought a lot of scary news. But somehow, by keeping us isolated, a pandemic accidentally brought us together. You learned how to give a haircut. Your kids discovered you're actually fun to hang out with. And you discovered that the view from your own window is actually pretty impressive. Home is everything. It keeps you safe. It keeps you centered. American Financial Network finances the American dream. Let us help see if you can make your home more affordable through refinancing or find you a great loan to buy a home that's all your own. Contact us today. We'd love to talk with you about the meaning of home.
All right, and here's just some contact information there, but I'm going to go on more things in more detail later on here for you.
This spring,
All right, now home buying process. There's a couple of different things that you want to look at here. One of the biggest things is getting qualified, getting pre-approved. You may hear if you ever reached out or anything of that nature, some of the realtors will say, "Hey, have you been pre-approved? Or have you been pre-qualified?" That's one of the things that is crucial because in order to be able to do their best to find a home that meets what you're looking for and your criteria, you want to make sure that it's helps save you some time to make sure you qualify for that home or for that property. Submitting some documentation. The documentation, a lot of times, you may seem like, oh, it's a ton. Sometimes it just may be a couple of different items. The reason is we want to make sure that we're verifying your information and just want to make sure everything is good to go so we can close smooth, quickly, and on time there for you. Finding that right realtor. Finding the right realtor is just as crucial as finding the right lender. You got to be someone that can understand your vision, what you're looking to try to do, but also someone that's professional and knowledgeable, that's able to help and assist you and guide you through the whole process here. You don't want anyone that's just rushing you through things. You want someone that can take the time to make sure they understand what your goals and your wants and your needs are, and that they can match you up to the right property for you. And that leads us to right to the next one. Find that right home. You want to find a right home that you know when you walk in it, you feel it, you understand it, but also make sure you qualify for that right home. Right now, you may want the biggest home on the block and the biggest yard, but maybe you're right now financially, it may be a stretch. It may be tough for you. It may be hard to get that one. So we want to make sure it meets a lot of your criteria, a lot of your needs, but also financially too as well. Making that offer, working with your realtor, and when I every person that I get pre-approved, I reach out to their realtor as well, just to make sure we all on the same page, working on your behalf there. So when you make that offer, your offer gets accepted there. Locking in your rate or your interest rate. Some of you may not be aware or understand, but when you first get pre-approved or pre-qualified, there's times where the you can lock in that rate. That means whatever rate that you get quoted, you can lock it in at that time. A lot of times that rate can be locked in anywhere from 30 to 45 to 15 days and 60 days. The reason why is that because in the market, it goes off of the industry, and the industry is sometimes it's governed by the stock market or the stock prices. So when that happens, is it fluctuates a little bit. It goes up and down and up and down. So it's not always, oh well, my lender quoted me this and now it's different. Well, if it's not locked in, it could go up and down. So it's not always your lender's fault. So that's why to know this up front, that hey, it can be locked or it may not be locked. You are aware. You are a more educated buyer out there. A more educated buyer makes the transaction goes a lot smoother for everyone involved. Getting your home inspected. A home inspection is a good thing because what it does is it allows a professional inspector to come in and can peek through things and lift up the hood almost like a car mechanic. Lift up the hood to see things that you may not be aware of. See things that may need a lot of addressing or may just need something minor. And can help calm you down and relax you through the whole process. So having your home inspected is a good thing to do so you know what you're walking into or what you're purchasing. And getting it inspected and getting it appraised is two different things. Some first time home buyers think it's all one and the same, but getting it appraised, you just have someone coming in and just looking at the surface. They're not doing a lot of digging, they're not doing a lot of looking behind the hood. They're just looking on the outside surface and the inside and say, hey, I see this house has granite countertops, and they compare it to the homes that sold in your area recently as well as currently on the market. So if your home has granite countertops and another home has granite countertops and everything looks the same, the floor plans look very similar, the same, they say, okay, yeah, this home is worth this amount. Or if the home you're purchasing has formica or wood block, or it's a little, dated and may have some wood paneling from the 70s. And then the homes in the area that recently sold, it doesn't have that. It has the nice painting, the 2001 look, and it has the island in the kitchen. That home may be a little bit worth more than the home you're purchasing, and this helps protect not only you as the buyer from buying something that's overpriced, but also helps protect the lender putting a loan on a property that is overpriced. It's a win-win as we look at it to make sure you're not buying anything that's well overpriced. Also for your budget in the market. Picking your homeowner's insurance. homeowners insurance, you want to make sure you pick that, and that's something that you can go and reach out and speak with any homeowners insurance in your area. Uh, Go into underwriting. Once the loan is underwritten, what that is, it just goes and make sure all the I's are dotted and the T's are crossed. Okay. Getting qualified. First thing you like to do is talk with a loan officer or a loan originator. Uh, what we do is check your debt to income ratio. That's one of the first things we do, just to see how things are, and also do a credit check to check the credit worthiness. Um, there's a lot of things that goes into a credit report, and I'm going to go into detail about that a little bit later. But debt to income, how much money you owe, far as your debt, the people you owe money to, credit cards, car notes, student loans. On the other hand, how much income you have coming in. So those are two things we look at there. So want to make sure that you're not over leveraging yourself. Again, it's not. People think, oh, they're just trying to stop you from getting a loan. That's the last thing we'd like to do. We want to make sure you're credit worthy, so you won't be stressed out or worry so much that you're in over your head. So that's what we look at there. Couple of documents that's needed for pre-qualification or pre-approval: driver's license or government ID, state ID, also passport you can utilize, social security card, W-2s, past 2 years. Now, if you are self-employed or have your own business, just look at 1099s or P&L statement, bank statements, things like that. Um, Also, tax returns we look at too as well, pay stub. And then one other thing is find that right realtor. If you want to find a realtor, you want to find a realtor that matches you well with your needs as well as your goals to the property you're looking for. And finding the right home that fits your needs and qualification. That is crucial. As I mentioned before, you don't want to buy a property or buy a home that not only doesn't meet your needs, but doesn't meet your financial needs or goals. You don't, even though you may be able to be qualified for a $260,000 home, that could be putting you top at your budget. So that means if you miss a day at work or things like that, you could be really tight. So maybe going at 220 or 230 may be best for you. So that's the thing there. We want to make sure that all matches up very well for you. Now, once you find that right home, you make that offer. Make that offer with the assistance of your realtor. And once it is accepted, then what we do is we will request a couple of things from you. One, earnest money deposit. What that is it's a deposit. It's pretty much stating that to the seller that hey, you are serious and you really looking to purchase your home, so you're putting down a deposit, and it can be anywhere between 0.5% to in some cases 5 or 10% of the purchase price. So that's something that you discuss that with your realtor to make sure that you understand what the earnest money deposit is. Now, once you do have that earnest money deposit accepted, you will supply your loan officer with a copy of not only the earnest money deposit receipt, but also the purchase agreement so we can get that interest rate locked in. Uh, Going back to getting that home inspected, it can identify the areas that you may need to address or areas where you may need to address with the seller. Again, these are things that can definitely help you out in your home buying process, just making sure that you're not getting any surprises there after the purchase. um, and with the appraisal, it can determine the home value is the same over what the offer states. That's one of the things there. If you state, hey, um, my offer is $100,000, but when you do the home appraisal, say, oh, the appraisal's worth 60,000 or 70. That's something that you can take back to the seller. It's like, hey, this is what's coming up, and vice versa. If you put an offer of 100,000 and the appraisal came back saying, oh, no, well, actually, the home is valued at 120,000. And right there, you pretty much can come in with having a little bit more equity in the property than you originally thought. So it's always good getting that home appraised. And in some cases, the appraisal can be waived. In different types of loans, different types of situations, appraisal can be waived where if homes is rarely newly purchased or a lot of homes in the area that matches up, so things like that. So there's a lot of little things that can come into play as we go down the process. If that is one of the cases, your loan originator, loan officer will definitely let you know that. Getting that homeowner's insurance, reaching out to either your current insurance provider and trying to add a quote. That's one thing, getting a quote for homeowners insurance and provide that information along. Once that's gathered all up, everything will be submitted down to the underwriter. As I mentioned before, the underwriter just crossing T's and dotting I's, making sure everything is verified and validated. Information from you, information from your income, looking at the credit report, getting information from the seller of the home, also the different agents, your agent, the seller agent. We also reaching out to homeowners insurance. So they just gathering all this information and making sure everything is correct, everything is up to date. So when you purchase a home, there's no surprises for you. That's the biggest thing. Some people will say, "Oh, there's a lot of work and a lot of effort," but when you think about it, it's best to get all this information up front. So when that time comes, when you go to closing, you're not surprised by something down the road. Say, "Hey, this house is only a two-bedroom legally, or this is have a certain liens on it." That's what go through all the underwriting to make sure all that stuff is discovered, if it is, so you'll be aware of it, so we can attack it or handle it up front for you. Okay, and one of the things here is closing with us. One of the biggest things you want to look at when you close with us is that on time closing. We focus on getting your loan ready to close and close on time. Um, Also, perfection. Your credit score does not have to be perfect. It's not required. We can go down as low as 560. Conventional is 620. VA is 580. USDA is 580 as well. And that's one of the things that we want to make sure that it's available for a lot of potential buyers and potential homeowners. So we want to make sure we can address that. And we are on your side. We work alongside you, not as a pushy salesperson, but as a partner, someone that can help get you to that end goal. If you're happy and your loan closed, we are as well. So we want to walk with you alongside. Um, the experience. American Financial Network has funded homes for since 2001. So we've been around for quite some time there with that experience and that knowledge that can help you through the process. And one of the great things is our communication consistently. We keep in touch with you throughout the process, give you the good information. If there's something comes up, a hiccup, we will definitely reach out to you to address it. So there's no surprises with anything there. And that is key. Even if sometimes bad things happen, sometimes hiccups happen, sometimes things happen. Just because it happened doesn't mean it's the end of the world. The biggest thing is letting you know what we're going to do to fix it, communicating that. Hold on one second. Let me grab a quick drink here. Thank you. And excuse me. Okay. Now, here's some of the top questions that first time home buyers wish they would have asked. Okay. One of the things that a lot of first time home buyers ask is they hear all the time mortgage, mortgage, mortgage. But what is a mortgage? Mortgage is just a legal agreement between you and the lender. Just pledge the home as a security. It's a securitized loan. Same way if you buy a car. One of the things there when you buy a vehicle, it the car itself is the collateral for the loan, and the same thing with the home. So there's no difference there. So that's what it's called the mortgage on that end. Um, Now, Here are a couple of different financing options. Excuse me, there that are available. Conventional, Fannie Mae and Freddie Mac. Some of you may have heard that, some of you may not, but those are terms there. Now, what that is it's a private lender, and it's guaranteed by a private lender to a lender. And one of the two sponsors enterprises that backs that is Fannie Mae and Freddie Mac. And with those loans, that you can go as little as 3% down. Now, a lot of cases, people who use conventional, they tend to put a little more down, anywhere between 10 to 20%. And one of the things there that you want to keep in mind, if you do a conventional loan and you have less than 80% equity, that means if you put down less than 20%, you will have what we call in the industry private mortgage insurance. What that is it's an insurance to help protect or help back the lender, the person who's lending the money. If for some reason, worst case scenario, you're not able to finish paying the loan, the government of the insurance is what's gonna fund or make that lender whole. If for some reason it gets foreclosed, you can't pay, that's what that insurance is for, just to make that lender whole, to try to pay as much as the balance off as they can, so the lender won't be out, because they are taking a risk when they loan out money to anybody. That's with anything. So just keep in mind that. FHA is another loan. It's one of the very popular loans. The reason why it's very popular because it's backed by a government uh, entity. And one of the things there with the FHA, the financial requirements are a lot looser, as far as how much money you need to have, as far as the debt to income ratio, your credit scores, things of that nature. It's just a little looser, so that's the FHA loan there. And again, that one you can come with as low as 3.5% as a down payment. And with this one as well, you have mortgage insurance premium or private mortgage insurance if you have that less than 20% down, as I mentioned to you with conventional. VA loan is backed by VA, which is for veterans, Veterans Administration. Now, these loans are for members who served in the military, currently serving, and also their surviving spouse, widow, or children. You can be as a veteran, you can pass along your benefits of that. Now, one of the great things about the VA loan is you can come and have a loan through VA with zero money down. That means no money out of your pocket down for this. Now, what they do offer is that they do have what they call a funding fee. Now, a funding fee is anywhere between 2.3%, anywhere from as high as 2.3%, as down as like 1.4, 1.5%. Now, it depends on how much money you're putting down as well. And also with this, you can have the funding fee waive depending on different avenues, where there's service connected disability or rating, things of that nature. You can also have the funding fee waive. Now, unlike FHA or conventional, with VA, you don't have to worry about the 80% equity when it comes to mortgage insurance premium or private mortgage insurance. There is no private mortgage insurance or a mortgage insurance premium for a VA loan. It's very similar to a USD loan as well. The thing is with USDA loans, those loans are for like rural areas, areas where there's a lot of farmland, or just land areas, vast land. So those are a little different. And with that one, there's no mortgage insurance premium as well, but there is a guarantee fee of 1%. Again, the difference is between the mortgage insurance premium and PMI, where you have a monthly that you have to pay, with the guarantee fee or the funding fee that the USDA or VA offers, is that one-time fee there. And then we have the renovation or new construction. We have those options there. So we have a lot of different products, a lot of different options that we offer. These just the major ones that we offer. We also have non-qualified mortgage ones, and those things are more along lines of investors or people that have multiple properties, things of that nature. Okay. Now, here is some of the things that you want to take a look at and be aware of. Not all mortgage loans or rate quotes are the same. There's a lot of different things that factor into that. And a lot of times this may or may not be accurate. So you just don't want to run into it and say, "Oh, well, this is what I saw. I want that." It may not be accurate. It may not fit you personally. So that's when you may call up. What's your rate? What's your rate? And a lot of lenders are not just don't want to answer the question. It's a lot that goes into that. The loan amount, the type, the terms, a purchase or a refinance, the loan amortization. It could be a 15-year, 20-year, 30-year. It could be interest only. There's a lot of different things. Loan to value, combined loan to value, location, the timing, um, condition of the occupancy, credit score. As you see, there's a laundry list of things. So it's not just one or two things. There's well over 20 items that could go into that. So that's why it's sometimes when a person just, what's the quote, there's a lot of things that go into that. So that's why a reputable as well as a very experienced and knowledgeable lender, you're just not going to throw out any price just to get you in. They want to make sure you try to get it as accurate as they can. So that's why they ask you these questions before. So don't take offense when they just don't give you that answer right away. These are the reasons why, okay? Now, there's a difference between pre-qualified and pre-approved. Some people think it's one and the same, but there are some differences there. Um, Again, a lot of the lenders that pre-qualified, not saying all, so please don't get me there. But a lot of them may just want to give you a quote. Sometimes it's very low, just to get you in, get you hooked. And then when they start doing some of the things, verifying that information, and it's not the same as what they quoted you, this is the reason why. Because when I do the pre-approvals, what I do is collect all the required documents just to verify, to make sure, and just give you a definite idea on one of the things there. And that's one of the biggest things because I know, sometimes it happens and say, hey, what's your credit score? Oh, man, 650, 670, 680. And then you run it and it's actually a 605 or 610. That Credit Karma, that free credit report, those things go off. It's because it's a consumer that's pulling your report. Those numbers are sometimes a little off than what we pull. So that's another reason why it's like, wait a minute, I just looked on Credit Karma, it was this amount. There's like 7 to 8 different credit reportings. Even between the three agencies, each one may have 8 or 10 of them. So there's a lot of different options there. So it's good to monitor it to see what's on it. But when it comes to the score, you definitely want to get it ran by lenders so they can pull up the more accurate information there for you. Okay. And moving on to the next one is this is what I was just explaining there. What is a credit score and how we use them? A lot of different numbers, a lot of different basics. The thing is, it can range from anywhere from 300 to 850. Now, if you're in the 300 range, you got a lot of work. Not saying it's impossible. Nothing's impossible when it comes to a lot of loans, a lot of options. It all depends on what are you willing to do and how long are you willing to take. So one of the things there we can help just about anyone, but we may not be able to help you today. So that's one of the things there to take and consider. That now we use these scores just to determine the risk. Higher risk loans, maybe get higher interest rates than lower risk loans. That's why it's important that you look around and you shop around for the lender that works for you. Now, again, as I mentioned, you don't want to just necessarily go with the first person. You can, that's fine, but you want to at least get at least 3 different quotes within 30 days, just so you can have that. Compare apples to apples and make sure you're getting the right product, the right lender that works for you and with you on that. So just keep that in mind there too. Okay. Some tips and tricks to try to improve those credit scores. Now, before I get into that, there's a couple of things that you want to look at. Credit is based on right about five different things there. Your payment history, the balance you owe versus what's available, the type of credit that you have. When it's what they call tread lines, you want to have different types, whether it's secure, revolving. Um, you want to make sure that they are different mixtures, and that's one of the things there too. The number of credit inquiries that you had, you don't want to have too many of that too. Then the credit history, how long. Um, One quick tip, and this is a quick one that's I'm giving out, and you know, you may know, you may not know uh, what a lot of people have done and will do. There are people that have a good credit score, good credit history, and what they would do, they will have a credit card and maybe put their children on it as someone that could, utilize the credit card if needed. Now, them being on that credit card is not saying that you don't have to give them an actual credit card. You could just put their name on it. Now, keep in mind, if you cannot keep that card at the low balance, that's going to affect them too as well. So you want to make sure it's a card that you can keep, that the utilization pretty low, just so it can start building up their credit history. So that's one a quick tip there. Now again, that's one of the things that has happened. So just keep in mind that's how you can build up that credit history. Um, Now, if you look at the breakdown there, it's broken down in five different categories. The credit history is about 15%. Pursuit of credit, that is, the running out inquiries, by different creditors, that's about 10%. The types of credit used, about 10. Credit history payment, that means that's is a big chunk. That is a one you definitely want to keep low. Um, Pay your balances. Make sure you don't miss any payments on things, because that could hit you, and it affects 30% of the 100% of your credit factors there. Also, outstanding balances. That's the thing, that the money you owe as opposed to what's available. You want to keep that around 30% utilization. Rule of thumb: if it's anywhere between 0 to 15%, it's great. So just keep that in mind there, though. That is one of the biggest things that I tell a lot of my clients is, if you have credit cards and if you are looking to purchase a home, and just keep your credit, not necessarily purchasing a home, but just to keep your credit score looking pretty good or keep it high, you want to keep it under 30%. Now, just want to give you a quick idea of what that will look like. If you had a credit card for $500, you're looking at having just a balance of available credit of 350. That's around 30%. So again, if your balance is higher that you have available, that's great. Okay. Now, this is how you can find out the most accurate information on your credit report. Every year, uh, authorized by federal law, you could request a free copy of all three of your credit reports from annualcreditreport.com. That's where it's free, and it's annual, so you only get that one time every 12 months or one time every year. That's what's checked. Again, Credit Karma is good for just monitoring now, and sometimes the Experian or TransUnion is good. Sometimes those have fees, but the free one that's the most accurate is the annualcreditreport.com. That comes directly from the credit bureau. But again, as I mentioned, keep in mind it's once a year. So if you get it in January and you do some things in September, October, it's not going to be on that January report, and you're not going to be able to access that information or things you've done until that following year for this. So you want to have both, but just keep in mind, annual credit report is where you can get it for free, and it's the most accurate yearly there. Okay. Now, how do you choose the best program? That is a good question. One of the biggest things that you want to look at is FHA better, is conventional better, is VA better, USDA better. That's where when you ask for a quote, it's hard to just give you just a number because you want something accurate. You have to talk with your lender, have that conversation, and go over all the information. Like, what are you trying to do? Are you trying to stay in a home for just a few years? Are you trying to be your forever home, 10, 15 years? Is it investment home? That's a lot of different questions that we need to find out and want to pin down which one is the best one for you there. Okay. Sometimes you may hear what this thing called discount points. What is the discount point? What is that? Discount points are fees that's paid to the lender at closing in exchange for a reduced interest rate or buying down the rate. So sometimes you may see advertisements saying 2.9, 3%, or 4% interest rate. But then when you go talk with the lender, they say, no, it's at 5%. You say, wait a minute, I saw 3%. Well, sometimes they're quoting you the lowest possible interest rate you can get, but only how you can get that lowest possible interest rate if you are buying down the loan or buying down the rate or paying extra money to get that lower interest rate. In some cases, it could be a good thing where you may pay $2,000 now, and over time, you may what they call recoup or have a return on investment, pay $2,000 now, and at the end of the loan, you save in six, seven, eight, nine, $10,000. So yeah, that could work better. Again, depends on your situation and where you are financially. So again, this is why we ask a lot of questions in the beginning just to see what will work best for you. Okay. Loan to value. Loan to value, that's a good question. People ask about that. That's the amount of money that you borrow compared to the purchase price. And, you know, case in point, if a lender say, hey, the max we can give you 80% loan to value of the property, and you need $100,000 to buy the property. So it's okay, what's the max? I mean, I need the 100,000. That means you bring in some money to closing. Now, just to keep in mind, if the property, for instance, is worth $125,000 and the lender say, hey, the max I can give you is 80%, that means the max they can give you is $100,000, which means you have to bring at least $25,000 to closing. So that will give you that 80% loan to value. Okay? So that was the loan amount divided by the property value, give you the loan to value. Now, what is included in your monthly mortgage payments? Great question. Great question. Now, things that's included in monthly mortgage payment is things like the principal, interest, property tax, homeowners insurance, and that mortgage insurance. That's that MIP or the private mortgage insurance. Before I go any further, I see there's a question here. So, okay, your question. You want to go back one? Okay. Um, okay. Your question I see here is if you had a property, a house you was trying to buy, and it is 180,000. What will if it is the 80% or no? Okay, let me no. If it is 95%, how much you need to bring that's what I'm understanding here. Okay, all right. So if it's 80,000 and you want to okay, the max they can give you is 95%. That's 95% loan to value. And so it's pretty much the meaning you bring that 5%. So if 80,000 and you do the math as I mentioned before, the loan amount, property value. So, but how do you get to that loan amount if you know the max that the house is 180,000 and the loan to value you can just do it opposite. The loan to value is 95%. You just do 95% times 180. So that means you will need to bring at least $9,000 to closing. So that's one of the things there. So the loan amount that they will be able to give you is 171,000. Okay. All right. I hope that helped. Alrighty. Okay. So where were we? We're back here. These are the different things that all is included in the mortgage payment. Now, I know some of you may or may not remember back in 2008 and 9, there was an issue with those, a lot of foreclosures at one point when we had that recession. And a lot of lenders at that time was allowing a lot of people to pay their property tax separately or their the homeowners insurance separately. So when it came down to the having issues, sometimes the individuals, when they didn't have any money, they wasn't paying their insurance, they weren't paying their property tax. So to alleviate that, a lot of lenders now there are some lenders that will allow you to pay separately, but most programs you have to pay it all included in a mortgage payment. So when we say, okay, as a lender, say, hey, what mortgage payment will you be comfortable with? We're not just talking about the principal and interest. We're talking about the principal, interest, and as well as the homeowner's insurance. So all of that be included, so you'll have a better idea. Okay, what you can afford monthly. Because if you come in and say, hey, the max I want to go is $1,100. So in our heads, as the lender, we're gonna talk with you as well. Okay, we say, well, that means with the principal and interest as well as property taxes, insurance, all that has to be, and if you have mortgage insurance or not, all that has to be under that $1,100 mark. So that will dictate the price of the home that that you can afford as well. Okay, and that's one of the biggest things that we want to make sure that all that is under, so you can be comfortable in making those mortgage payments there. Okay, now one of the things you may hear a lot is escrow. Uh, Escrow is established by the lender on behalf of the borrower, so the property tax and homeowners insurance can be paid by the lender when those bills are due. And that's where that um, property taxes and insurance come into play. What it is, the lender will collect all of that when you pay your monthly mortgage payment, and when those bills are due, the lender would distribute it out. One thing people say, well, what if I pay too much, or what if my property tax go down? What if my insurance go down? Things of that nature. That's fine if it goes down. By law, the lender is not allowed to hold on to more than what the property taxes are. So, if that is the case, that money has to be refunded back to you. So, rest assured, you uh, you are protected in that instance. It will be funded back to you. But again, you do it this way just to make sure that those things are being covered. Because at the end of the day, they want to make sure that there's no encumbrances, no liens, or nobody trying to come after the property while you're in it. Okay. Uh, when I mentioned to you before, what is mortgage insurance or private mortgage insurance? Um, Again, it protects the lender if you fail to pay. As I mentioned, is usually put into place if you put less than 20% down, and then there are many options to help fit your needs. So again, we try to do best we can to make sure you as a borrower are protected, but also as a lender protected too as well. So be a good relationship as a partner in this. Closing costs. When it comes to buying a property, there's more to it than just a down payment when you're using a loan, or if you're not using a loan. There are things called closing costs. Closing costs are things, for instance, that those fees and estimates. If your lender has a loan origination fees, if you having points, also what they do is when it comes down to purchasing a home, when it comes down to escrow. A lot of lenders collect 1 to 2 months of mortgage payments just to make sure when the things are closing that you're not paying that following month. For instance, if you close in June, they try to collect those 1 to 2 months so you don't have to come out of your pocket in July or August to pay your monthly, that's already collected ahead of time. So that ease you into your home without worrying about, oh, I got to turn around and pay a mortgage payment right away. Okay, so it's just almost like a prepayment. We collect that and that's put inside your closing costs as well. Now, if there's anything as far as title search fees, title insurance. Title insurance is when um, you have a title company do a search. Then again, same thing, that information that goes to the underwriter. Make sure that there's no other liens, no other parties trying to lay a claim on this property. That is a clear and clean title, as well as in certain states there's attorney fees. Um, those are things that is all included in the closing costs. And those closing costs vary from state to state. It could be anywhere between 1% to 5%, depending on the state. So again, those are the things that goes back to one of the reasons why when a person asks, "What's the closing cost? What's this?" We have to factor in all this stuff and give you an estimate to our knowledge. And that's one of the things. That's why it's not always right away we can spit out a number, because we want to make sure we're accurate too. So that's one of the things that we take in consideration there. And just to keep in mind, those closing costs can be paid by the buyers and sellers. I know right now in this market, um, a lot of times the sellers is a little hesitant on that, but it can be. But then also it can be gifted by a family member or credit paid by the lender too as well. So keep those things in mind. Just again, ask your lender, are there other options? And there's a thing called down payment assistance program. So there's a lot of different things out there. Just make sure, this is one of the reasons why I put on this, so you can be aware of the different options that's available for you. Okay. Now, what happens when I apply for a loan? How does it actually work? Okay. Now, what to do? What happens is the lender works to verify all the information on your loan application that you put in. They also order appraisals to verify the value of the property. Uh, have title work. The title work. Search everything, review it, just to make sure there's any issues in there. If there are, try to get them resolved as quick as possible, just to make sure you have a clear title. And then collect all the documents and everything that's needed, and we'll send it over to the underwriter for the approval. And once it's approved, the thing is, we'll schedule the closing for you there. I see a question here. Typically, depending on the loans, I know you hear that a lot, but when it comes down to closings, closings can take anywhere between, from start of the application to finish, depending on where you are in the process of finding the property. It could be anywhere between 15 to 45 days. Again, depending on the loan, depending on how quick we can get the documents to verify, depending on your market. So that's just a range there. And on average, we've been averaging here around 20 to 25 days on average for closing loans. So we're trying to keep things fast, smooth, but also try not to rush anything there too. Okay, now what responsibilities do I have during the lending process? The key thing to remember is to keep your financial circumstances steady during the loan process. Uh, we want to make sure that you're not doing anything that's going to affect that. So if you're not sure, just ask. That's one of the biggest things. Just ask. I'm here. I'm here to help you through the process. Don't be afraid. Don't be thinking, "Oh no, I can't ask him this. This is crazy. This is ridiculous." Just ask a question, and I will answer it for you. Hold on, let me take a quick sip of water, real quick again. Alrighty, here. Move right along. Some of the things to see here. The Ten Commandments when you're applying. You don't want to quit a job or become self-employed. Not in the middle of the process. You don't want to buy a car of any type, because again, that will add to your debt to income there. Buying furniture with money you set aside for the loan, you don't want to do that as well. One of the biggest things is things need to be verified. So if you normally receive $1,000 every week from your job, that's fine. But when you start seeing 3,000, 4,000, 5,000 start, populating in your account, one of the things that the lender's gonna know is, okay, well, try to verify where's the money, where's it coming from. Again, it's not that we're trying to be all nosy and just want to know exactly where you come from. The Frank Dodd Act that came out, and the Patriot Act that came out years ago, it's just to try to catch what they call mortgage fraud. Not saying that everyone's trying to defraud anybody. It's just saying there are people that's out there doing this. So, in order to avoid that, if there's large deposits, we want to just try to verify where those large deposits coming from. Also, large deposit could be coming from another loan, and that could affect your debt to income ratio. So you don't want to have those big, large deposits, big, large things coming in and out. And if there are income tax or a settlement or something like that, we would just ask, okay, we need some documentation to verify that. That is all. And if you have money set aside, five, 10, however much you have set aside in the bank, leave it in the bank. Do not go in there and as soon as you get paid, take it all out. It's going to be hard to verify that. So leave the money in the bank. And if you want to use, if you that's the only bank account you have, and you set aside 5,000 for your closing cost and down payment, and you just got 6,000 there, 7,000 there, you want to use some of that. You can use some of that as long as the money you have set aside is still there. That's the biggest thing. So it's not, again, it's not like we're trying to be on those and say, oh, I see them they using Uber Eats a whole lot. That's not the thing. The thing is, we you just don't want to have. You say you have 5,000 set aside, and it come down to closing, and it's gone. It's like, wait a minute, you use that to get approved, but now it's not there. So now we may not be able to close your loan. So that's why you don't want to spend the money that you have set aside. Um, don't let any accounts fall behind any excessive charges. You don't want to be transferring things from bank to bank to bank to bank. Because if you do, as I mentioned, we'll be like, okay, well, where is it coming from? We need bank statements from there. We need bank statements from there. That's the thing there. To avoid all that, the money that you're using for closing, the money that you're using, have it set aside. And if you can, try to avoid it. Have it. If you had another account that you want to use your daily expenses, that's fine. But the money for you have set aside for your closing costs and everything, you want to make sure you leave that in there. Um, and please, please, please do not stop. Don't stop paying rent. I mean, don't. You need to pay your rent. You need to pay your mortgage. So keep doing that. Don't. I know that was a double negative, but please keep everything moving freely and flowing. So keep paying your rent, keep paying your mortgage, keep paying your car note, keep paying all your bills. Uh, you don't want to originate any new inquiries as well. You don't want to co-sign on anybody else's loan or anything like that and while you're in the process. Again, I mentioned about the large deposits. Which I, just you talk to us first and talk to me first, and I'll let you know. You don't want to admit any debts or liability. If there's a debt or liability out there, again, just ask me, and and I'll let you know. Don't say anything. Then it comes up because again, I'm gonna have to ask. Like, hey, what happened here? What happened here? So just let me know. Not, we understand stuff happens, things, mistakes. Not gonna get persecuted for it. It will have to be addressed. So don't worry about that. Okay. Now, what do you do during your walkthrough? During your final walkthrough, you definitely work with your realtor. You want to examine things, corner empty houses, check the floor to ceiling, make sure if there are things or problems that the seller stated it's going to fix, make sure it's fixed uh, just before you close. Typically, I know working with your realtor, they because that's the person you're going with, they will let you know a good time. A lot of times it'd be the same day of closing. If you're closing at 2 o'clock in the afternoon, you may want to swing by the house the day before, same day, early that day, early that morning. Um, Again, not saying that everybody's trying to do things crazy or um, fraud or anything like that, but it has happened. That's why it's being addressed. Just do a quick walkthrough, make sure everything's there that's supposed to be there, so you know what you're buying at the end of the day. Now, what to expect happen on a closing day? Closing day, wire the money that's required. Some cases you can bring a check or a cashier's check, but typically having it wired, your portion to stay at closing, the lenders will wire their portion as well. Um, Before all that, you definitely be speaking with the title company or the escrow company to make sure they have all your wire information or you have theirs. There will be a lot of paperwork. There will be a lot of documents to sign. You typically will get it to review a day to 3 days prior to make sure you understand everything. Make sure if you have any questions that you can ask, and it typically will be the same information on closing day, but we want to make sure that you get a day or two in advance so you can review everything. Whether you send it to your lawyer's or attorney, or you want to reach out to me, ask me, talk to your realtor. That's why we get them in advance, so you can go over all that information right before closing day. So you're not sitting at the table and say, "Wait a minute, you know, I was told $500. Now it's 5,000. You didn't bring that, so you want to make sure that you get all this information ahead of time so you can review everything." Okay, and then what's the steps here to secure? These are things that you bring with you. Um, yeah, I know a lot of times you may have sent it already, but sometimes that something came up, we may need another copy of it at closing. So these some of the things that we may say, hey, bring this, bring that. But the biggest thing is if you already have it or you already sent it, and also updated copies, because you could have started your process back in January, but now you're closing in May. So sometimes we need updated pay stubs, updated bank statements. Again, we will walk through you through the whole process, uh, moving up to that. But again, these are just things to keep in mind. And as you see here, when it comes to the bank statements, this is crucial. This is what I see all the time. They will try to send me bank statements, and towards the end, you may have a blank page. May say intentionally left blank. So, like, they don't need a blank page. What are you gonna do with that? There's nothing on it. We need to see all pages, even if it's blank, even if it's intentional. We need to see all pages. And please, screenshots. I know it's 2022. A lot of people use screenshots. That's great. That's nice. I understand you like using them, but we would need to see the actual full PDF, whether it's a PDF online that you have that you can send over, or you can scan them and email them to us. Either way, we just need all pages there. Okay. All right. Here's just a quick thing. I just wanted to make sure I go over with you here. Rent versus own. Some people say, I don't want to buy a house right now. I'm renting this $1,000. I'm fine, and that's okay. I mean, that's great, and I understand. But think about it. If you can qualify to purchase a home, why not? Think about it like this. Let's say you bought a home in 2012 for 250,000. Now it's worth 200. Excuse me, in 2022. So that's 10 years. It's worth $700,000. That's $450,000 in equity. That means if you sell a house, let's say, for instance, the balance is the same. That somehow you still owe $250,000 on it. You still will have $450,000 in equity if you would have sold it. But now, if you was renting, when you move, you may get your security deposit and your security deposit back. So that's $2,000. So you see the difference there? So that's why, buying a home is definitely beneficial. And as you see, just a 10-year gaps there where rent, this is what it's costing. This is what's happening. You renting for 1 year. This is it. This is it. There is no equity when you just renting, and the rent gonna go up every year. In most cases, the rent goes up when you buying a home, and every month go by, your mortgage is what it is. It's not going up. Your mortgage is staying the same. So you're getting equity when you buy a home as opposed when you're renting. When you're renting, it's just costing you. When you're owning, you're getting equity every year. There's a difference there. Any questions? Okay. Well, okay. I see here you asking me where can you find my information. All right, I'm gonna get to that, but that's the last slide. Again, my name is Will Upshaw. So I'm gonna go over that part there. Okay. Let me see here. The other question is, all right, bankruptcy. Okay. If you had a bankruptcy in 2019, could you purchase a house? Okay. Now, great question. And one of the biggest things with bankruptcy, people believe or thought, oh, if I file the bankruptcy, it's over, life is over, I can never do anything else. And that's incorrect. And if you heard or looked or read about that, the previous president, he filed bankruptcy several times. Bankruptcy is designed to, it's a reset button. And it also depends on which one you file. There's a difference between 7 and 13. 7 is reorganization. They try to eliminate a lot, if not all, of your debt. If you do file bankruptcy and you start over from scratch, that means all your debtors will be wiped away, or a majority of them will be wiped away, and you start over from scratch. That's 7. And 13 is when they take the debtors and will try to settle for less than what you owe. And you make monthly payments on that. Now, chapter 7, you're looking around a minimum 2 year period after things has been what they call a discharge. That means once everything is finalized and the documents went through and they sent all the information to your debtors and say, hey, this person filed bankruptcy, you cannot collect from them, things of that nature. It's 2 years after that date. So you said in 2019. So you're looking like you should be okay around this time, but again, we just have to verify that information to make sure, because sometimes it may have started in 2019, but it may not be completed. So we just have to verify that information. And then with chapter 13, you're looking around 3 to 4 years after that has been finalized. You cannot get a new loan during the bankruptcy while you actually going through it. So that all that have to be discharged. But again, once if it depends, so it depends if it's 7 or 13. And once you talk with your lender, you provide all the information, and from there they can look at the most recent guidelines and which product, because conventional, VA, and FHA has can have different guidelines when it comes to that too as well. So that was a great question, but it also depends on those different things. So talk to me offline and reach out to me, and I could, do some checks and do some digging to find out your particular situation and see what we can do to help there. Okay. Any other questions? Okay. All right. Well, I don't see anything else here. So again, my name's Will Upshaw. Thanks for stopping by. Here's my contact information again. Be sure to reach out to me. Also, you can connect with me here. You can connect with me on social media, AFN Will Upshaw, on Instagram, NBC Finance Group, and YouTube, Number One Lending and Real Estate podcast. Now, one of the things I'm going to do, I'm definitely going to make sure I upload this information. So definitely feel free to go to YouTube and like and subscribe when you have a moment. That way, you can look back, and if it was something that you didn't get, or you just want to hear it again, either reach out to me directly, I can answer it, or you can always go on there and reach out to me there too as well. Again, thank you for your time. Thank you for stopping in. And again, feel free to reach out to me. I'm here to help. I'm here to assist. But more importantly, I'm here to give you the information, education that can help make you a better informed home buyer. Thank you for your time, and have a great one.